Hello everyone, my name is Archie. Welcome to my channel. In my previous video, I talked about the biggest risk factor in 2022 for investment. In this video, I want to talk about how we as investors should spot this risk from coming and how we as investors should protect our portfolio to benefit in this risk factor, or in the least to protect our money. So if you didn't watch the first video, a little bit of summary. So the logic behind this risk factor scenario, I call it worst case scenario, is basically this capital war scenario where China is kind of creating this inflation in the world, and eventually for the purpose of for the United States to print more money so that their people can keep the same standard of lifestyle and the economy doesn't collapse. And once the US decides to print more money, the dollar gets further weakened, and China is in a great position to kind of push the US over the cliff by selling the US bonds that they hold. They hold about $1.1 trillion out of $28 trillion of United States Treasury bonds. And if they sell the bonds, they're going to raise interest rate on the United States without United States consent. So this is the concept of capital war. This is discussed extensively by Ray Dalio. And but his discussion, as far as I know them, they are kind of centered around the trade war scenario in 2018 and 2019. So I don't think he has kind of come out and updated his capital war view in terms of today's scenario, in terms of today's data. So in this scenario, we're going to have higher interest rate in the U.S. in North American markets, and housing price gonna go down, stock price gonna go down, while at the same time, the stuff that we actually need to live, the prices are gonna stay up. We're gonna have shortage of goods. We're gonna keep having shortage of supply chain, various things that have to do with supply chain, chips, whatever, you name it, right? And in this case, we're probably gonna also see weakened U.S. dollars. So how do we protect ourselves in this scenario, and how do we know if this is going to happen, right? Because if we always try to protect our money for the worst case scenario, we're never going to make money, and we're probably going to lose money most of the time. So we want to understand what the worst case scenario is, and how do we know when it comes. So in my opinion, how to spot this scenario, how do we know this scenario is going to happen, is if we see continued worsening relationship between China and US. I would say, as far as relationship goes, countries probably are at the worst of the relationship. Ever since they had a relationship, Kissinger and Nixon, they went to China in the 70s and they started a relationship. And ever since, I think that the relationship was becoming better and better. And probably after, I would say, maybe 2013, 2014, the relationship really maybe became a little bit more rigid, and in 2018, clearly we had a much severe worsening of the China-U.S. trade agreement, and now we're probably having the worst relationship with the Russia situation, with the supply chain situation. And the second point is that if we see the continued lack of production from China, so we're gonna keep monitoring their COVID policy, how quickly are they shutting down the cities, the supply chain, and how long are they shutting down the supply chain. And it's going to give us a better understanding in whether or not they're doing this on purpose or they're truly trying to curb their COVID situation. It's going to, a way that I'm monitoring this, and it is showing me that they're doing this on purpose so far, is I am looking at cities where, for example, they have 60 COVID cases, but they are not getting shut down as severely as, for example, Shenzhen did. So, and the final point is definitely the most obvious. If we ever see Treasury yields spiking, that's going to be bad, right? That's basically interest rate has been raised. And if Treasury yields spike to the point that, to the degree or to the motion that it can only be explained by a huge player in the market dumping their Treasury bonds, I think that it's pretty clear tell that we are kind of going to be in a dangerous situation, and we need to start think about this video. That's why I'm making it, right? So what assets will do well and what assets will not do well? Number one, the good old American farmland. So how this business model works in farmland is that, let's say, for example, say hypothetically, I own 400 acres of farmland, and I clearly have two options here. I can either rent the farmland out for like third-party farmers to operate, to farm their agricultural products and sell and pay me rent, so that will be my income. Or I can operate, I can be the farmer, I can have a company that actually takes care of the farming. So, but I would say most of the time, the person who owns the farmland, they're kind of a real estate investor. They're not like they maybe they understand a lot of aspects in like farmland products and agricultural products, but I would say that most of the time they're not expert, and they need to be focusing their energy and time and capital on acquiring more farmland rather than operating the farmland itself. So how farmland is structured is farmland rent is structured based on food prices. So the more expensive that type of food gets, the owners say, hey, come on, man, you're making so much money in your selling your corn, selling your soybean. I need to be taking a cut, okay? So rent is based on food prices. So in the 1970s, we saw that CPI data spiked, have these two spikes that went over double digit. And we saw at the same time real corn prices, so this is inflation adjusted corn prices, also kind of spiked. So basically showing us that what these two graphs really prove is that in the inflation environment, it's very hard to not have the food prices also be inflated. Food prices, in fact, one of the first thing that gets inflated. So if you want to protect your purchasing power, that one of the best assets to buy is actually farmland, because say grocery bills become more expensive, so gas prices become more expensive. How do you hedge these prices? Clearly, like you can hedge through future contracts, but like as regular citizens, as regular people, we're not trading futures contracts. And also, if you don't understand futures mechanism, you can easily lose a lot of money very, very quickly. But how do you say buy an asset that has a good incoming producing characteristic while it is very not volatile, it's very safe? It's probably farmland. So when agricultural products become more expensive, farmland rents go up, and farmland itself is worth more money. So in the 1970s, stock market, after adjust for inflation, stock market investors lost 50% of their value. In fact, in the 1970s, if you look at the stock market, I actually had, I think, maybe 2 or 3 down years. So like 70% of the time, the stock market had nominally positive returns. And I think the whole 1970s stock market return was something less than 7%. It was still a positive number, so this annualized return for the whole decade. But it was brutal for them because the inflation was too high. So yes, your stock was making you money, but it's not making you money as fast as the inflation, the money itself becoming worthless. So in the 10 years, farmland had risen from 730 per acre, from 130 per acre to 737. Wow, so basically a $600 gain on top of a 137 base price. So that is 14 price every year. Investors who purchase farmland with a modest amount of leverage, a 30% down payment, and a bank loan. So the 737 over 137 is 14%, is basically the project IRR, is a project rate of return. It's not the levered, because a portion of this money is financed by bank financing that has a much lower interest. So on the equity side, you're looking at 24.7 average annualized return. Wow, for 10 years, 25% return every year for 10 years. I have some, for all disclosure purposes, I have some money in farmland products through the offering of a private fund. So just putting out there. So if you seek farmland exposure in the public markets, A lot of private funds for farmland, they have a minimum investment threshold. So if you have to be a accredited investor or something like that to be buying these products. But let's say you're not, you have $10,000, $25,000 in the portfolio and you want to protect your purchasing power. There's also farmland exposure in the public markets. Not a lot. The best one is probably this Gladstone land. This stock has absolutely been going berserk to the upside. If you look at this chart on the right side, ever since September, September is actually the time. I think October was the time I put my money in the private farmland fund, and it has gone up by 1% since. So then I look at this chart. If I put the same amount of money in the farmland ETF that's offered in the equity market, I would have gone from $24 to $37. And by comparison, I made 1% in the private farmland fund. So it's a, I don't know. I don't know if the private farmland fund, I don't know if I've been scammed, or I don't know if, I don't know what is happening. So anyway, so let's move on to the next one, consumer staples. Consumer staples products are basically the stuff that you need like for your like day-to-day like livelihood, like toothbrush, like I think there's different definition of consumer staples. I think there, like toilet paper is definitely consumer staples, like toothbrush. Some people, they think that like Coca-Cola or cereal, they're also consumer staple products, because people who drink Coca-Cola, they're gonna keep drinking Coca-Cola. So it's very hard to move away from these products. That's why it's more stable. And Procter & Gamble is probably one of the biggest, one of the most well-known consumer staple company producer in the world. However, if you look at their stocks for the past, say, ever since 2022, they crashed along with the other public markets like technology stocks and everything. They didn't crash as hard. I think their stock only went down, let's say, from 164 to 144, so $20. So their stock went down probably by like 14%. But by comparison, technology stocks went down by 20 something percent. So it's definitely some degree of protection, I would say, compared to a lot of more volatile technology stocks. But I understand that anytime you buy stuff like farmland, even the farmland fund, and even the consumer staple stocks, anytime you buy anything in the equity market, in the secondary stock market, you are exposing yourself to high volatility and overall a degree of correlation to the equity markets. But overall, I think that consumer staple companies are good buys in this risk scenario that I'm describing, because primarily that they have good incoming producing products, and that people will need to buy. Doesn't matter how much gas price go up, right? Gas price can go up to $17 per gallon. I need to use toilet paper. I need to buy cereal for breakfast. Like, I'm not gonna have a little bit less cereal because the gas price has gone up, right? So their business model, the core business model, is not gonna get hurt, but their valuation metric could get hurt. Like, they could go from a 18 multiple to a 16 multiple just because the market doesn't like it anymore. And in today's context, it's more like going from a 25, 26 multiple to like a 22 multiple, and that can get hurt a lot. And good assets, number 3, well-funded growth companies. So that's growth. So well-funded growth companies, and that's your Amazon, Meta, Microsoft, Google, Apple. That's like these stocks. They have a lot of money, a lot of cash flow. They have, in fact, too much cash they don't know what to do with them. But however, I believe that FANG will start to differentiate themselves from each other. Some are better capitalized. They have good fixed rate debt, and they have good growth opportunities. And some FANG, they are not going to be benefiting from the same type of environment. For example, Netflix. I don't believe that Netflix is a very well capitalized company, and I don't believe that their growth opportunity will be there in the same way it was in before. That's why I didn't put Netflix logo. However, I believe that overall these 5 companies are going to do pretty well in the future because they are all 5 of them, as far as I'm concerned, are very well capitalized, and they are going to keep growing. They always want to be. They're always seeking better growth opportunities out there, and many smaller technologies firms, they are going to be suffering quite a bit in this scenario because this scenario is, there's a lack of liquidity in the market. Interest rate go up, money becomes more valuable, and that money becomes a little bit of a luxury product in the capital markets. Right now, cash is trash, right? Like, oh, this company is trying to do something cloud computing related. Let's fund him. How about let's fund him $200 million? But under this scenario, money is going to be a lot scarce, and when money is scarce, you are going to only fund companies that you are more sure it's going to grow well and has solid cash flow already. So a lot of small technology firms are not making money. They're going to suffer. However, I do believe the opportunities are there for certain technology stocks. So this is Beyond Meat. So Beyond Meat in March 2021, probably the best time in terms of Beyond Meat stock. They had a note offering. They had $1 billion of convertible note. I think converted at $206. Now the stock is 40 something. So when they offered this, they had about 60% upside before conversion. The stock was, I think, $140. Now the stock is $40. So it's a long way from this potential dilution, potential conversion. Even if it ever gets near that point, I think the equity holders at today's world, in today's time, they're gonna benefit greatly, right? And if you look at the balance sheet, this is not a Beyond Meat video. I probably will make one in the future, but I just want to quickly mention that, so far you can see when they raised the debt. They had $1 billion jump in cash in March 2021, and so far the one thing that kind of concerned me is that they burn about $150 million in cash on a quarterly basis. So right now they have $750 million in cash left. So that takes them about 4 or 5 quarters to burn through the rest of the cash. So that's a year and a half. So I'm the concern from me on Beyond Meat is that, are they gonna make this cash last, or are they going to just burn through the cash in the worst? And then let's say the worst case scenario does happen, they're gonna run out of cash at the worst possible time, and it's gonna be pretty bad. And the long-term debt, they do not have other debt, so their debt is very linked to the cash. So the long-term debt is their convertible. So yeah. And the stock, as I said, has been crushed. So they raised their debt right here, and the stock kind of jumped. And I think that as it was jumping, they either raised it or and the stock quickly retreated, and now it's 40 something. It's actually just closed above 50. So now let's move on to suspicious assets. So suspicious assets, I named it here by, I don't know how well they're going to perform. They could either perform pretty good or pretty bad in this scenario. Now, all these asset performance are this scenario. If this scenario doesn't happen, this video is not needed. This video does not apply. Disclaimer: this video does not apply if this scenario does not happen. So if this scenario would happen, residential real estate in the 1970s, they performed kind of mediocrely because higher interest rate made a lot of people lose jobs, and once they lose job, they don't have money to pay rent. So there's kind of this glass ceiling on rent increase. So as a landlord, you can't increase your rent above certain threshold, because then nobody's gonna come live in your apartment, because they already have higher gas prices to pay. They already have higher food prices to pay. They're not gonna have more income left to pay rent. However, they do have lower volatility than stock market, and inflation environment typically drives the higher growth for real assets like mining, like real estate, like commodities, than stock market, than bonds, right? So gold, Peter Schiff's been on this gold train for a long time. Performed absolutely amazingly in the 1970s. It went from $38 per ounce to $500 per ounce, something like that. It performed incredibly well in the 1970s. That's why this time, if this scenario were to happen, I think that gold is going to spike a little bit because people are going to expect some similar performance. However, I think I put in the suspicious assets because I do not see a time where investors are pouring their money into gold when they have no money, when assets prices are going down and they they need to fund their company, otherwise their company are going to fail. It just not something I see happening. So I put it in the suspicious bucket. Equity market overall performed mediocrely. We talked about equity market overall cannot beat inflation in inflationary environment. And by equity overall, I think it's going to have positive nominal returns. So nominal returns meaning that it's still going to, your number in your bank account is still going to grow higher, but it's not going to grow higher to the degree to protect yourself in this high inflation, high unemployment, stagflationary scenario driven from the capital war. And not to mention that most stocks are denominated in US dollars. This is why Peter Schiff and also Bridgewater, so Redalius Fund, they're also, if you go to their website, if you look at their the CIO's videos, they really are talking about staying away from US denominated equities. Finally, crypto. This is an asset clearly we didn't have in the 1970s. Theoretically, it should benefit from high inflation because crypto is limited assets, right? So this is like gold. They call it digital gold. So it's limited in quantity. So it's kind of like any precious metal. However, the lack of liquidity in the market is, again, just like gold. I don't see, gold is stuck in the 2,000 range and Bitcoin is down and is stuck in this $40,000 range. I think for the similar reason, honestly, they're not income producing. One has this prestige to it, which is gold. One has this cool factor, world is going to change, to use Bitcoin perspective narrative to it. But they're both not income producing. When people don't have money in the capital markets, when there's a lack of liquidity, it's hard for me to see either one of doing very well. So what are the bad assets? Bad asset number one is long bond. This is easy. In the inflationary environment, you do not want to be long bond or long credit. Hey, bud, can you lend me $1,000 and I'll buy you a sandwich in a year? This is a horrible deal. That doesn't sound like a good deal to me. So what does that mean? If I borrow $1,000 from you, say, you as a viewer, I borrow $1,000 from you, you give me $1,000, I can buy whatever. I can buy an iPhone, right? And in a year, the dollar gets weakened so bad that $1,000 doesn't mean crap, and I just I pay you back $1,000 and $10 interest, 1% interest or 2%, $1,020, and this $1,020 can buy you a hamburger because that's how bad inflation has turned out to be. Now this is an extremely example, right? This is not gonna happen in real life, but this is basically the same idea. You lend out money. So you lend out money, they spend your money in the meantime. In the future, they pay you back your money with interest, but the time has passed so that your principal and interest can buy you less stuff than your principal that you lent out in the first place during the time when you lent it out. So the second bad asset, in my opinion, is consumer discretionary. So this is stuff that you can easily cut out from your life. Oh, gas prices is going up, food prices are going up. I have no more money left. What do I need to cut? I need to be cutting something. So this is stuff that easily cut stuff. Think about your life. What is 3 things? What if you go bankrupt? What if you become much poorer? And what are the first 3 things? First spending you cut? Those stocks, stay away from those stocks. Hey, but want to go for a drink at a local fancy bar? No thanks. Gas bill have bankrupted me. Consumers have less money to spend on cool stuff. They're not going to be buying the newest iPhone, which is actually a huge risk factor for Apple. They're not going to be buying the new cool, Yeezys, shoes, Nike shoes, or whatever, the $400 shoes. And they're not going to, go out to see Ed Sheeran the next time he comes to town. So because they have no more money to spend. Obviously, this is not everybody. Some people are going to spend the money, but Some people are even gonna go on debt to go see Ed Sheeran. Like, you know, people behave differently. But overall, this is what happens, right? This is Nike stock. Nike stock has behaved in this way that a market kind of anticipate this risk factor to happen. So we saw that Nike is, you know, going down big time, and I personally think that I will not touch Nike stock with a 10-foot pole right now. I will not buy Nike stock until they, you know, go below the blue line I drew here, which is their previous to 2020 high, which is about $100, $105. Right now it's trading at $131. It's come down a lot from the $180 high, but I will not be touching Nike stock with a 10-foot pole right now due to what I said. I think the inflation are not to be stopped here, and I think once the inflation becomes more and more rampant, this consumer discretionary are the first to go. Okay, thank you guys. If you have any questions, let me know in the comment section. Thank you. Bye bye.